Hello, and you're welcome to Global Business Insights, where from a global perspective, we discuss insights, ideas, and answers to questions in the fascinating places where finance, culture, and business converge. First, we look at markets. Yesterday, the Dow Jones Industrial Average traded higher, recovering following a sell-off in the previous session. The Q3 earnings picture for the big banks consistently beating Wall Street estimates helped. Morgan Stanley rose 7% after topping Wall Street estimates for both its third quarter earnings and revenue. United Airlines also reported better than expected results and forecast strong numbers for the last quarter of 2024, sending shares 15% higher. Early voting has already started in the United States presidential elections as markets seem to be shrugging off any uncertainty concerns, signaling instead an institutional resilience irrespective of whoever takes over the White House. UK inflation fell more than expected to a three-year low of 1.7% in September. That's data coming out yesterday, prompting the pound to fall and traders to increase bets on further rate cuts from the Bank of England this year. Yesterday's release by the Office for National Statistics shows inflation has come back under the Bank of England's 2% target for the first time since April 2021. Today, we saw US retail sales up by 0.4% after a 0.1% rise in August and exceeding expectations for a 0.3% monthly gain. Retail sales, excluding autos, also better than consensus by 0.5% from August's 0.2% advance. Also in today, the count of US citizens filing new applications for unemployment insurance rose to 241,000 for the week ending October 11. This was below the consensus forecast and the previous week's tally of 260,000. That was revised from 258,000 citizens. The European Central Bank Governing Council today decided to lower the three key interest rates by 25 basis points. This is the third quarter point cut by the ECB since June. As such, the interest rates on the deposit facility, the main refinancing operations, and the marginal lending facility will be decreased to 3.25%, 3.4%, and 3.65% respectively, with effect from the 23rd of October 2024. The cut comes with the latest September Eurozone inflation at 1.7% after falling from 2.6% in July to 2.2% in August. We will feature a clip from Lagarde's speech earlier today. As we see geopolitical risk in the rest of the world surging and a trend of easing of interest rates in global markets, there is fresh interest and revival in capital flows to emerging markets like Africa, including new demand for bond issuance as investors are attracted to better yields. Nigeria is accelerating reforms which it hopes will dramatically reposition its economy for improved stability and growth. In Nigeria, October 14th to 16th at Abuja, the Nigerian Economic Summit flagship event marked 30 years in leading its advocacy efforts for a better Nigeria, also marking a significant milestone in the journey of progress and impact. Chairman Niyi Yusuf comments on takeaways from this year's discussion, which featured a comprehensive agenda, including a fire chat with Jamie Dimon, CEO JP Morgan Chase. UK inflation fell more than expected to a three-year low of 1.7% in September, prompting the pound to fall and traders to increase bets on further rate cuts from the Apex Bank this year. Core CPI, that's excluding volatile energy and food prices, came in at 3.2%, also lower than the expected 3.4%. Inflation below the Bank of England's 2% target paves the way for further interest rate cuts, making borrowing money less expensive, but also lowers returns for savers. Analysts see a greater likelihood of an interest rate cut by the bank in December after a widely expected reduction from the current level of 5% in November, thus giving mortgage providers confidence to reduce the interest they charge on new fixed rate home loans. There is still nervousness on the UK budget to be announced by Chancellor Rachel Reeves on 30th of October. Lower inflation means lower than expected benefits bills. It could also drag fewer people into higher rates of tax, even though the thresholds have been frozen, meaning less tax revenues, leading perhaps to more pressure to raise corporate and capital gains taxes higher. There is optimism that inflation in the Eurozone is now trending below expectation, even though inflation is expected to rise in the coming months before declining to target in the course of next year. Domestic inflation remains high as wages are still rising at an elevated pace. But first, let's listen to a clip from Christine Lagarde's speech after the decision to cut rates by 25 basis points was announced today.
Annual inflation fell further to 1.7% in September, its lowest level since April 2021. Energy prices dropped sharply at an annual rate of minus 6.1%. Food price inflation went up slightly to 2.4%. Goods inflation remained subdued at 0.4%, while services inflation edged down to 3.9%. Most measures of underlying inflation either declined or were unchanged. The risks to economic growth remain tilted to the downside. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by sources of geopolitical risk, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could also disrupt energy supplies and global trade. Lower demand for euro area exports due, for instance, to a weaker world economy or an escalation in trade tensions between major economies would further weigh on euro area growth. So to conclude, the Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission.
Also, when asked on the risks associated with the Trump U.S. presidency as a result of higher tariffs and fresh trade barriers, Christine Lagarde observed that this could indeed be more downside as the ECB analyzes the context on a meeting-by-meeting basis.
Trade is obviously an important element, and as part of the drivers of activity going forward, we obviously have consumption and investment, but we also have trade. And any restriction, any uncertainty, any obstacles to trade matters for an economy like the European economy, which is very open. Trades within itself, of course, but trades also with the rest of the world. So any hardening of the barriers, the tariffs, the additional obstacles on that possibility to trade with the rest of the world is obviously a downside.
The chairman, Nigerian Economic Summit Group, Niyi Yusuf, summarizes takeaways from the 30th annual summit. The group have for decades been consistent as the point of reference for optimum stakeholder participation and enlightened discussions on the economy, balancing analysis with recommendations on the way forward.
We understand there's more than $2.3 trillion of private capital available on the continent. But that capital will go to destinations where it's guaranteed decent return on investment. And so the onus is on us in Nigeria to ensure that we provide the right incentives, we create the right environment that will attract the private capital into this country. And that becomes important as we have a weak currency. And so an opportunity for us to drive and boost the export of non-oil exports. And part of the requirement for that is to have an industrialization plan that defines what we have competitive advantages in, how we'll do additional processing and value add, and the market to which those will be exported, so that we can then drive non-oil exports and have more effects that the CBN can use to build up our healthy reserves. Delegates ask for policy consolidation. We have a raft of policies from the trade, from the fiscal authorities, from the monetary authorities. Delegates ask for some consolidation, some alignment to ensure that those policies are really integrated and complementary to each other. And the complementary of policies also then require that we have alignment between the fiscal authority, the monetary authorities, social safety authorities, and lastly the trade and investment authorities. So we've got all four to work together to help provide relief and to help boost growth in today's market. We looked at the African Continental Free Trade Area as an opportunity of 1.4 billion market, a significant market. And so there's a requirement for us and the private sector in Nigeria to tap into that opportunity of AFTA, which is what the industrialization plan will do. And in the mining sector, there was a compact that was signed by the private sector operators in the mining, what is called the African Mining Vision Plan. And it's a plan that, when implemented, will boost local processing of solid minerals and, of course, from the mines to the market. Beyond policy consolidation, delegates also ask for price stability. The range of FX volatility, inflation rate, all those needs to be stabilized. And in addition, delegates asked for regulatory consistency and for regulators to focus on boosting trade, boosting business, and less of generating IGR. No, you can't tax companies to death. And it's important that regulators focus on how they can enable and create an enabling business environment. And part of the enabling business environment and part of what is also necessary going forward, it's more reduction of the public debt. So in terms of the public financial management, that also needs to be really and aggressively looked at so that we reduce the debt burden. The revenue to debt ratio now it's about 68%. So for every 100 naira that government hands, maybe 2/3 of that is used to service debt, which is not sustainable. And so we need to focus on public financial management, and a way of doing that really is reducing the expenditure. So cost of governance, the Rosario report needs to be implemented. We also need to accelerate privatization of some dead assets or underperforming assets, so that way we can attract the much needed private capital, but also the private expertise that will ensure that those assets are now yielding fruit and providing quality public service.
Well, that's it from me on Global Business Insights. This is Bode Oshosami. Bye-bye.